Here we go. The purpose of central banks like the Fed is to protect the banks, not you.
Some experts worry that the dollar's dominance may be under threat.
For decades, our country has been looted, pillaged, raped, and plundered by nations near and far, both friend and foe alike.
When you're saving those fake dollars, this will still be here. This could be the biggest opportunity you'll ever see.
What's up, guys? It's Graham here, and this is unbelievable. In the middle of tariff negotiations, retaliation from China, a weakening dollar, and global uncertainty, one investment has quite literally become the ultimate money printer, and that would be gold. That's right, while trillions of dollars are being erased from stocks in a matter of hours, gold is up nearly 30% year to date. It just hit its 55th record high in the last 12 months, and even Donald Trump just said that he who has the gold makes the rules. I mean, it's rather incredible, but with some analysts now calling for gold to potentially hit as high as $5,000 an ounce, we should really discuss why investors are suddenly cashing out and buying safe haven assets, how gold is quickly becoming the best performing asset of 2025, and if it's too late to buy in. Because despite gold now outperforming the stock market over the last 8 years, there are some major risks that everybody should be made aware of, especially before it's too late. Although before we start, as usual, if you appreciate breaking news videos like this, it would seriously mean the world to me if you hit the like button or subscribed. If you haven't done that already, it does actually make a tremendous difference for the entire channel, and as a token of my appreciation, I will do my best to read and reply to as many of your comments as I can. So thanks so much, and also a big thank you to Incogni for sponsoring this video, but more on that later. Alright, so in order to understand why gold has become such a popular investment and how high it could potentially go, we need to start here: currency. Unlike the US dollar, or really any fake money that could just be printed out of thin air, gold has been used as a viable currency for thousands of years. After all, it's difficult to come by, it doesn't rust, it doesn't tarnish, it doesn't degrade, it's easily moldable, it's functional, and it's so rare that all the gold mined in the world could fit in a 23-meter cube. However, in terms of the United States, gold didn't really make a formal appearance until 1792, when Congress passed what's called the Mint and Coinage Act, which created gold and silver coins in various denominations. From there, other countries around the world wanted to standardize payments for global trade, so the gold standard was adopted. This guaranteed that the government would redeem any amount of paper money for its value in physical gold, meaning transactions no longer had to be performed by handing over heavy bars, but rather paper currency that could later be redeemed for gold at the bank. This worked incredibly well for decades, until it didn't. After the Great Depression, in 1933, people began getting rid of their paper money in exchange for physical gold, and as demand skyrocketed, bank reserves started running low. So as a way to stop demand from outstripping supply, President Franklin D. Roosevelt and the government signed Executive Order 6102, which banned private ownership of gold and required that all citizens give back their physical gold in exchange for paper money. This resulted in the US government now having the largest stockpile of gold in the entire world. And after World War II, most countries simply pegged the value of their currency to the value of the dollar because our dollars were backed by gold. So if they had a dollar, it was theoretically just as good. Again, until it wasn't. See, in 1970, the United States budget was ruined by the Vietnam War. Global demand for gold began increasing faster than what any reasonable currency could keep up with. So as a way to help introduce more money into the economy, our dollar was removed from the gold standard, allowing the government to pretty much do whatever they want. And from this point on, our money was only backed by the belief that it is worth what they say it is. This resulted in the demand for gold skyrocketing, going from $35 an ounce in 1970 to $594 in 1980, which works out to be $2,445 in today's prices adjusted for inflation. Over the next 30 years, however, the value of the dollar eventually stabilized. Gold prices remained fairly flat, and every time the government seems to print more money, the price of gold continues on its trend to the next all-time high. So does this make it a really good investment? Well, so far, in terms of what gold can buy you, overall it's held its value incredibly well. For instance, since the United States abandoned the gold standard, the value of our dollar has dropped 85%, while the price of gold has increased 85 times. In this case, even though the stock market has become the default wealth builder, anytime inflation runs high or global uncertainty increases, the price of gold continues to jump higher because it's seen as a hedge against a falling dollar. Even better, but when you take a look at its performance, there are three main points to consider. One, gold has outperformed US bonds, commodities, and global stocks over the last 20 years. Now, even though the US stock market technically has higher returns, over the last decade, gold has seen an annualized return of 8.3%. And during times of economic unrest, gold not only remains fairly stable, but it also makes a lot of money. Leading to number 2, gold outperforms the stock market in times of volatility. For example, during Black Monday of 1987, when stocks dropped 30%, gold barely had any change. From there, gold only fell 12% during the dot-com crash compared to 44% for the S&P 500. And during the COVID crisis, while markets dropped 20%, gold dropped by only 0.86%. And 3, it is highly liquid and lags only the S&P 500 in terms of trading volume, meaning you could sell it at any time. However, if you think that gold has become the inverse of the stock market, where it only goes up while everything else is going down, well, unfortunately, you're going to be somewhat disappointed. As Ben Carlson of the Wealth of Common Sense blog points out, the monthly correlation between the stock market and gold is essentially zero over the long haul, and even over decades, it's still rather unpredictable. Like, both stocks and gold rallied at the same time throughout the 1980s, 2010s, and 2020s. While inflation remained high in 2022, gold remained completely unresponsive. And only recently did the price begin to come to life, now that we're seeing global unrest and lost confidence in the dollar. Although in terms of what could happen throughout the next year, and how high gold prices could potentially go, you're going to want to hear this. Although before we go into that, I just have to say I am shocked. Let's get back to the video. Alright, so in terms of gold as an investment, and how much money you could potentially make, let's talk about profit. It's important to clarify that prior to 1971, the price of gold was fixed by the government at just $35 an ounce, since our dollar was held to the gold standard, and this money had to remain stable. This is why most gold charts really only start around this point, giving us 54 years of data to look back on. And here's where things get very interesting. As Ben Carlson mentions, who I'll link to down below in the description, by the way, for anyone who wants to follow along, from 1971 to 79, the price of gold increased by 1,300%, or a compounded annual return of 33.8% a year. Now, even though this seems like an amazing return, many people believe that this was simply the market playing catch-up from the government artificially keeping the price substantially low at, again, just $35 an ounce. This is why, to get an accurate understanding of how much gold actually goes up in value, we need to look at the prices beginning in 1980, which paints a completely different picture. For instance, from 1980 to 2023, the price of gold increased by just 3.2% a year, lagging stocks at 11.7%, bonds at 6.5%, and cash at 4%. At the same time throughout all of this, inflation averaged 3.2%, meaning over 44 years, the price of gold increased by pretty much nothing. Now, even though this might sound pretty discouraging, during an economic crisis, gold actually holds up pretty well, or if anything, goes up while everything else is losing money. For example, from 2000 to 2009, the S&P 500 fell while gold rose more than 14%. Even from 2000 to 2023, gold is up an annualized 8.5% a year compared to the S&P 500 at 7%. However, if we just change these dates slightly, from 2009 to 2023, the S&P 500 is up 13.8% a year compared to gold at just 6% a year. And even at today's prices, with the market falling and gold skyrocketing to new all-time highs, gold is still up an average of 5% a year from 1981 through today, while the S&P 500 increased by 8.8%. And this is where some very unique trends begin to emerge. Generally, gold outperforms during times of high inflation, economic uncertainty, and global turmoil that results in the dollar falling in value. And since gold is completely detached from the government, people rush to buy into it while financial institutions are under pressure, like they are right now. Although in terms of whether or not it's a good time to buy, here's what I found very interesting: the gold to S&P 500 ratio. This tracks how many ounces of gold is required to purchase the S&P 500 index. The higher the ratio, the more valuable stocks become relative to gold. And the lower it goes, the more valuable gold becomes during economic uncertainty. This consistently tracks back to 1928, and when the S&P 500 takes just 1 ounce of gold to purchase, it's usually a pretty good time to buy into stocks. Now, obviously, this ratio isn't perfect, and there are several different aspects to take into consideration, but generally, when economic uncertainty is high, gold does well. And that's why several analysts believe that if this trend continues, gold could go even higher. For example, the billionaire Jeffrey Gundlach believes that we could see 4,000. Goldman Sachs believes we could hit 4,500 in an extreme case scenario, and Rob McEwen predicts that even $5,000 could be in the cards, even though he owns a mining company and could be a bit biased, but that is besides the point. Generally speaking, the worse our economy does, the better gold is going to do. And even when you look at the value of our US dollar, 152 currencies have failed from hyperinflation, and we've never had a reserve currency last longer than 110 years, all pointing to the fact that being diversified right now is a good thing. Although, in terms of investing in gold at today's prices and where it might go in the future, here's what I think. Overall, I treat gold as a hedge against one thing, and that would be fear. The more people fear inflation, defaults, economic collapse, and the downward spiral of the US dollar, the higher gold becomes. And right now, we have a lot of fear. Like in just the last 24 hours, the chairman of the Federal Reserve, Jerome Powell, was called a major loser for not lowering interest rates. And Trump is reportedly studying as to whether or not they could legally fire the central bank leader before his term is set to expire. We also have China vowing to retaliate. They're warning other countries not to undercut them in negotiations. And as we get closer to the deadline of 90-day tariff pauses, it doesn't seem like much progress is being made. This is why gold continues going higher, while the value of the dollar keeps getting weaker. But this doesn't mean it's going to continue happening in the same trajectory. That's because when it comes to gold, the higher the price rises, in a lot of cases, the better of a value stocks become. And the higher stocks rise, the better of a value gold becomes. At least when you zoom out over decades. Like sure, over certain periods, you absolutely have times where gold outperforms the stock market, or the stock market outperforms gold. And it's really just about cherry picking the select dates that fit whatever narrative you want to get across. This is why I don't see gold as a replacement for long-term investing or something to YOLO all of your money into, but rather a way to diversify part of your portfolio to give you something else to fall back on. This is also why a good portfolio isn't just one investment, but rather a mix of different asset classes, all of which are meant to help you stabilize during times of economic uncertainty. Like in my case, I have a mix between cash, treasuries, US stocks, international stocks, real estate, and a Bitcoin ETF. I'm quite literally invested in just about everything throughout the entire world. All of these are in varying amounts, and if the market continues falling, I have cash and treasuries to buy in cheaper, and if the market goes back up, well, I'm still invested. I haven't sold anything, and I get to capture all of the upside as well. Honestly, in my opinion, an allocation to gold wouldn't hurt, and over the last year, you actually would have made a lot of money. It's just not something that you're supposed to go all in on, or YOLO to try to make as much money as possible. Really, the strength of gold is simply its ability to store value and be around in times of economic uncertainty to hedge against everything else falling. And most models seem to forecast that it's a good idea to hold between 5 to 15% of your portfolio and no more than that. But for me, I would rather just invest a little more aggressively. I don't mind the volatility, and since I have a long-term outlook of the next 30 years, that tends to suggest that stocks still beat gold over the long term, and that's the way I'm generally going. Sure, this could very well underperform in the short term, but then again, I'm just a dude in a half-converted garage making YouTube videos, and I have no idea what I'm talking about. So if you agree or disagree with me, let me know down below in the comment section, and I will do my best to read and reply to as many of you guys as I can. And also, make sure to hit the like button, subscribe if you haven't done that already. Sincerely, it means a lot. Thank you so much, and until next time.
President Trump just announced that tariffs on China might be coming down soon, and the stock market loved it. We saw the Dow Jones jump by more than 1,000 points on the news that there will be no trade war. But let me break down what's actually going on. That way you can be a smarter investor. Right now, the United States has a 145% tariff on Chinese goods. And in response, China has put a 125% tariff on United States goods. What does that mean? That if you're a company doing business in China, you are probably losing a lot of money. So companies like Apple, Walmart, and Tesla, who do a lot of business in China, have been bleeding because of these tariffs. So much so that there are many economists that are saying that these tariffs could put the United States economy into a recession. But this is where the White House says, have a little bit of patience. This temporary slowdown because of tariffs are better for the long term because it will allow the United States to renegotiate our trade deals with these countries to be more favorable for the United States. We just don't know when, and we don't know what it's going to look like. But for the first time, we might have a little bit of light at the end of the tunnel because President Trump has just said this about China specifically. Quote, 145%, the tariff is very high, and it won't be that high. It will come down substantially. It won't be zero. It used to be zero. But that's not all. Treasury Secretary Scott Bessent also had a meeting with JP Morgan Chase Bank where he supposedly said this, that talks between the United States and China would likely lead to a de-escalation. This is the hope that many investors have. The tariffs are going to be chilling out soon, and this is what caused markets to rally. However, nothing has been finalized yet, which means you can still expect more volatility ahead. Now, we've been covering all of this in Market Briefs. Again, Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the economy, the stock market, the housing market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning. Plus, when you join Market Briefs, you'll also get our Investing Masterclass as a bonus for free just for joining Market Briefs. If you want to get Market Briefs and our Investing Masterclass as a bonus, all you have to do is click the link down in the description below to join. Now, there's a few things that I want you to understand. We don't know exactly what's going to happen with tariffs yet. It's just rumor and hope and speculation, which is causing the stock market rally and upward and downward momentum that we've been seeing. The question that we don't know is what's going to happen with the economy in the meantime. We know that President Trump wants to see lower interest rates. If you've been watching what's happening in the financial news or reading Market Briefs, you know that President Trump has been bashing the Federal Reserve Bank for not cutting interest rates. Jerome Powell, who is the chairperson at the Fed, said that he wants to wait and see what's going to happen with tariffs and inflation before he makes any adjustments with interest rates. President Trump says that we have no more inflation, so we should be cutting interest rates to stimulate the economy. Well, this is where President Trump also just responded saying, quote, I would like to see him, Jerome Powell, who is the chairperson at the Federal Reserve Bank, be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. Again, Jerome Powell said that he does not want to raise interest rates, so it raised the idea that maybe President Trump might be looking to fire Jerome Powell or finding a way to get him fired because technically the president doesn't have the direct ability to fire the chairperson of the Federal Reserve Bank. This created a lot of uncertainty where you had a lot of central bankers around the world and a lot of economists essentially saying that if Jerome Powell gets fired, it would create a stock market sell-off. Well, President Trump just responded to that by saying, I have no intention of firing Jerome Powell. So President Trump wants the Federal Reserve Bank to cut interest rates as a way to stimulate the economy. But it doesn't look like he's going to be firing Jerome Powell anytime soon, which gave investors a little bit of hope and calmness that that stock market volatility might not be something that they have to worry about right now. But the reason why you generally cut interest rates is as a way to stimulate the economy. And what the Federal Reserve Bank is saying is we don't know what's going to happen with tariffs. If these tariffs really stay in effect for long enough, it could make the inflation problem worse. Why? Because businesses could be paying 10, 20, 50, 100% more to produce some of their products, depending on where these products are produced. And that could force some businesses to either A, cut their profits, but also B, raise their prices on consumers, which could make the inflation problem worse. And that's why the Federal Reserve Bank does not want to cut interest rates right now. Why does that matter to you? Because the interest rate that the Federal Reserve Bank sets will ultimately impact the mortgage rate that you pay, the credit card rate that you pay if you have credit card debt, and car loan rates on car loan debt that if you're thinking about buying a car or financing a car, that's something that could affect you. And so if the Federal Reserve Bank does not cut interest rates, those car loan rates, mortgage rates, credit card debt rates will continue to stay high. But investors are still concerned about the economy, despite the fact that President Trump is saying that maybe we'll see some relief in the trade war. Why? Because we're seeing investors look for safer investments. Traditionally, gold has been known as a safe haven. It is the investment that traders and investors turn to when they're worried about inflation or the economy or a recession. And what we've been seeing is that gold prices continue to break new record highs. Now again, we don't know exactly why investors are buying gold, but if we just take a look at history, generally investors buy gold when they're worried about the dollar, they're worried about the economy, they're worried about a recession, they're worried about something bad, so they turn to gold. Now, as somebody who's been buying gold for a long time, what I can tell you is I don't look at gold as an investment. I look at gold as a physical store of hard money, because my theory is if I bought $10,000 worth of physical gold today, and I took $10,000 worth of physical cash today, and I buried these two things in my backyard, and then I dug them up in 10 years, my theory is that the gold would have more buying power because of inflation. And what we've been seeing is a lot of investors have been turning to safer investments like gold because, well, it looks like they might be concerned about the economy. They might be concerned about inflation. They might be concerned about the dollar. Part of that could be because of tariffs. Part of that could be because of uncertainty, because we've been seeing a lot of uncertainty. And the one thing Wall Street does not like is, of course, uncertainty. Even the Federal Reserve Bank has talked about this. The Federal Reserve Bank has talked about how there's still concerns about inflation. But the thing that I want you to understand is you cannot predict what's going to happen tomorrow. There's a lot of uncertainty out there. Even in we'll call it a normal environment, when there's no concerns about tariffs, there's always uncertainty. We don't know what's going to happen tomorrow. We don't know when the economy is going to enter a recession. We don't know what the stock market's going to do, and that should not be your goal. That's what traders do, and we know statistically that most traders lose money over the long term. Your goal is not to predict, but rather to own. Own investments for the long term. Own good investments for the long term. And when you see those good investments go on sale, meaning when you see market volatility, when you see downturns, when you see crashes, when you see recessions, use them as a buying opportunity to buy good investments. But how do you do that? Number one, you have to be able to identify what is a good investment. This might mean you want to find certain stocks that you want to invest in. You start to do that research early on. You start to figure out which companies you want to own, or maybe you just want to invest the broad American economy. You can invest in the S&P 500, which again is a group of the 500 largest companies in the stock market. Now, I got to give you the disclaimer. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But what we know is that over the long term, the American economy has been resilient despite recessions, despite market crashes, despite depressions. And along with that, the stock market has grown as well. Does that mean that we don't see market crashes? No, we've seen 25 bear markets over the last 100 years. A bear market is when the stock market falls by 20% or more. So we've seen 25 stock market crashes over the last 100 years. We're going to continue to see more market volatility. We're going to continue to see more market crashes. But now when you keep this in mind, we know markets go up, we know markets go down. We know that the economy goes up, we know the economy goes down. But if we believe over the long term in the American economy, well, all you want to do is not try to predict, but try to own. You want to own a piece of the American economy. More specifically, you want to be able to buy at a discount. So be prepared, meaning if we know volatility is ahead, we know that there's still no guarantee on tariffs, we don't know what's going to happen tomorrow, next week, or next month, chances are we will see up days and down days. When the volatility happens, if you already know what is a good investment for you, a down day creates a good buying opportunity for you. It can create a good opportunity assuming that you have a long-term mindset. Long-term does not mean 1 month. It does not mean 6 months. It doesn't even mean a year. A year is really the minimum time frame, but we're talking multiple years, especially a decade plus. When you have that type of time horizon, now you can start to see the risk go down, especially if you're not investing in an individual company. If you're investing in the broad American economy, the longer your time horizon, the lower the risk. And a recession is actually a good thing for you. A market crash is actually a good thing for you because it allows you to come in and buy more of a good investment at a discounted price. But of course, you have to have money to invest. So now you identified a good investment. You understand that when you see volatility, it can create a buying opportunity. But now you got to have the money to invest. And this means you got to start being smart with your money. And of course, that is hard during a time where we're still dealing with inflation. Of course, it's hard during a time where the job market is tight. Of course, it's hard during a time where we saw so much inflation over the last 5 years. But the reality is the reality. I'm not here to sugarcoat things for you. I'm here to show you what the reality is. It's not going to get easier. And so if you want to build wealth, you have to learn how to live below your means wherever you are today. Whatever your salary is today, you got to spend less than what you earn, period. Now, when you do that, you take the money that you don't spend, you put some money aside for savings. That way, in case something goes wrong or bad, you don't have to go into credit card debt, and you take the other extra money and you put this money to work. You invest this money. That way, this money can work to make you money when you're not working. So you're working hard at your job, your business, whatever you're doing to make some money. And now that you're not spending all of your money, you can put some of this money to work to also make you more money. Now, of course, investments don't always go up, but if you have good long-term investments, what you want to do is buy more investments at a discounted price because your goal is to own as many assets as possible. So it would make sense to buy more of those assets when they're cheap, right? Well, when things go down, many people panic and they run away. The stock market is the one place where when things go on sale, people run away. When Amazon has a sale or Macy's has a sale, people line up around the corner with their credit card in hand ready to buy. When the stock market is on sale, people run away, they panic, they say that the economy is going to collapse, they say I never want to buy a stock again, they say the system is rigged, they say that the whole thing is against you and you should not invest your money. But that's the best time to be buying when there's blood in the streets. Now, of course, we don't know how long things will take to recover. We don't know if we're going to be entering a recession. We don't know the future, but we can look at history. And while history doesn't exactly repeat itself, it does rhyme. And you know that when those downturns happen, they can be some of the best buying opportunities. And I'm telling you this from experience. I don't say this to brag. I'm telling you this from experience because, well, obviously I was buying when 2025 volatility was happening. I talked about that. But let's talk about 2022. When the S&P 500 fell by 20%, I was making videos talking about how it's a great buying opportunity. And I was buying. In 2020, when the stock market fell by 40%, same thing. I was making videos talking about how this is a great buying opportunity. And I was buying. In 2008, or after 2008, when the housing market got demolished, I was buying. I wasn't making YouTube videos then, but I was buying. Those things, those opportunities created the ability for certain investors to come in and buy great investments at a discounted price. You don't have to be a financial genius, okay? I am not a financial genius. I'm a random guy on YouTube. But when you understand the game, that when people are running away, it creates a good buying opportunity for good investments. That's the key. It has to be a good investment because if you're buying something on the verge of bankruptcy, well, then you lose everything. And yes, there are ways to diversify by not investing in an individual company, by investing in a fund like an ETF, or by doing the research, depending on where you are in your financial journey. Some of you may want to research individual companies. Others of you might hate that idea. You just got to find what's right for you. Personal finance is personal. I can't tell you what to do. I'm not a financial advisor. I'm just a random guy on YouTube. But the whole idea is when you find volatility, that creates opportunity. But it only creates opportunity for the financially savvy that understand how the game works. That's my goal with this video, is to help you to understand, yeah, we got some good news that maybe the trade war might not be happening, but we don't know what's going to happen yet. And while everybody gets caught up in the politics and the emotions and the arguments, I want you to read between the lines, find the opportunity, and use it as a way to build wealth instead of as a way to get angry or excited or whatever the emotion is. Find the opportunity. That way you can take better care of yourself, you can take better care of your family, and you can take better care of your community. That's what I want you to understand. And again, if you want some more resources, you can check out Market Briefs, which is my free financial newsletter. And you'll also get my investing masterclass when you join as a bonus as well. And with that, I will see you on YouTube tomorrow.
Said that you have spoken to President Xi. When did that happen? China says it hasn't happened.
I spoke to him numerous times. So we're leaving and going to Rome, where we'll be attending the funeral of Pope Francis. Some of you are going to go. Anybody going? And it's going to be very interesting. We're going to meet with a lot of the foreign leaders. They want to meet. Trade deals are going very well. I think Russia and Ukraine, I think they're coming along, we hope. Very fragile. And Iran, I think, is going very well. We'll see what happens. We're working on plenty of things that shouldn't be worked on because none of this stuff should have happened. This should have been taken place by Biden. It should have been fixed by Biden, but he couldn't do it, nor could he come close to doing. So anyway, we're going to Rome to pay our respects, and we'll be leaving that same day. We'll be coming back home tomorrow night. And I'll see some of you over there. Otherwise, I'll see you on television.
Meeting this morning. You said you spoke with President Xi. Have you spoken to him since the tariffs? When did you last speak with him?
I don't want to comment on that, but I've spoken to him many times. Yeah, kind of a guy.
Time magazine that President Xi called you. When did that happen, and what did you discuss?
I'll let you know at the appropriate time. Let's see if we can make a deal.
Well, there we go. The latest on the tariffs and everything in that world. Pretty wild. Please like, please subscribe. See you next time.